Over the quarter, the factor funds did reasonably well with returns of between 6 and 7% net of fees for investors, bringing their year-to-date returns to between 12 and 13%. And since inception, on an annualized basis, all of the portfolios have returned in excess of their inflation plus targets. In our previous podcast at the end of the second quarter of the year, we mentioned that we took some risk off the table before the Brexit vote happened. That's not because we had perfect foresight in terms of the result, quite the contrary in fact, but what we did think was the market was too relaxed about the potential that the vote would go against Britain's inclusion in the EU. As it turned out, that was the case, and we were able to profit the following day as markets fell because we were less invested than we otherwise would be. We took that opportunity then to get back into the market the following day on that Friday, and we ran up with the markets ever since. Now, a lot of that came because sterling was weak, and the market's pricing in the fact that because these revenues, which are generated outside of the UK by global companies, get translated back into a weaker currency, that means greater profitability for UK companies, and as a result, we've seen the stock market do quite well on the back of that. As a result, that's a bit of a one-off phenomenon, so we thought as the markets went up, we should again take a bit of risk off the table, take some profit and bank it, because we do expect to see some more volatility come out of the wash as and when more realities about Brexit are known. Nevertheless, in the second half of the quarter, because the market was stable and it had consolidated over that second half of the quarter, we decided to start putting that money back to work because the immediate risks and immediate nervousness had dissipated. And so the second half of the quarter, we're just buying back gently into the UK stock market to be roughly where we were now before the vote again. Well, the portfolios still have a large allocation to active managers and biased in the equity part of the portfolio towards the UK in particular. That's because we believe that if you're trying to beat inflation in the UK, it makes sense to have a decent allocation to UK businesses, which should, over the cycle, generate returns in excess of their domestic inflation level. Elsewhere in the portfolios, we have an allocation to government bonds, but we keep that relatively small because we think they're very expensive. So we have allocations to investment grade credit, which is high quality corporate debt, and that's meant to compensate for that downweight in government bonds. And then we've also got positions in high yield, which is lower quality credit, convertible debt, which is a debt equity hybrid security, and then emerging market debt, which is debt issued by emerging market governments. The third quarter of the year, again, equity markets did pretty well, so we've washed up with that. The bond markets, the fixed income markets also did reasonably well. A lot of that, though, is because of sterling weakness, and so foreign currency returns are boosted by the fact that your reporting currency, sterling, has fallen in value. We've also done quite well from our manager selection over the quarter. We've got a lot of managers who outperformed their various reference indices. A notable one, Copernic, which is a global contrarian manager. They did well in the previous quarter, we mentioned them then, and again, over this quarter they did very well as their contrarian stocks, their valuation-driven philosophy, and the fact they're invested outside of the UK largely, all benefited returns again. There's a lot of talk at the moment about whether the stock market is starting to get a bit on the expensive side, and so this is the key decision for us as investors today. We think that it's through fair value probably. It's not as cheap as it was a couple of years ago, but I think we still need to be careful. I think it's still actually reasonably good value. So we still see good opportunities in the equity market through the cycle for long-term investors. We do expect interest rates, and we've already started to see this happen, but interest rates in the UK start to drift up as a bit of speculation on inflation has come into the mix as sterling's weakened. That tends to be an inflationary factor, and as a result we do expect interest rates to continue to go up a little bit gently in the UK. And interestingly, in this environment where we're seeing low interest rates, it probably doesn't need much of an interest rate rise for these asset classes to become attractive again. And as they do, we will selectively move back into the gilt market, increasing our allocation to UK government bonds to get a better insurance policy into the portfolio. We've come a long way post-financial crisis. In the last 8 or so years, we've seen extraordinary efforts by central banks to keep liquidity in the system, keep the economies turning over, and whether it's in the form of QE or TARP or ZERP or NERP or any of these other acronyms we've heard over the last few years, we do seem to be running out of runway in terms of extraordinary monetary policy ultimately. Where do we see that going? I think it's likely that you'll see a greater emphasis on fiscal policy at some point, taxing and spending, or at least lowering taxation, increasing spending to add further stimulus into economies. And in fact, Theresa May and to a point Philip Hammond, her Chancellor, have actually started alluding to that fact already. Elsewhere, I think we've also got to remain cognizant of the UK's invocation of Article 50, the fact that that will cause uncertainty and nervousness, and with uncertainty and nervousness almost always comes stock market volatility. Now, we don't think that this is a long-term problem for the UK, but in the short term, as stock market investors, we have to expect bouts of volatility. For us as long-term investors, that's our friend. We use that as an opportunity to get in the markets at a better price, but also understand that it produces riskiness and volatility in terms of your returns. So keep diversified, don't keep all your eggs in any one particular basket, and remain alive to opportunities as and when they're presented to you.